Tomas is on. Diana, only one question from Tomas the entire webinar. He only gets one.
Only one. Okay. All right, my screen share should be off. It's 10:01. We'll go ahead and get started. You guys can hear me okay, right?
Yes.
Yep, sure can.
Great. Well, hello everyone, and welcome to today's webinar, Portland Metro Economic Updates and Real Estate Trends. I'm Diana Collin, Professional Standards Manager and Education Director here at PMAR. We are so glad you could join us this morning. This is a 1.5 hour session. If you stay in for the full program, you'll receive a CE credit certificate by email within the next 3 business days. We're in a webinar format today, so we can see your names. You heard Evan calling out some of you, but you won't be on camera. But if you have questions at any point, feel free to drop those into the chat. We can see some chats there going on, or the Q&A down there at the bottom of the screen. And along the way, Evan and Noah will try and get to your questions and see what they can do to get you some answers. So what has happened so far in 2025 and what might still be ahead? Today, we're going to take a timely look at the Portland Metro economy and housing market at this mid-year point. You're going to hear about key economic indicators, consumer sentiment, housing activity, and most importantly, what to keep an eye on as you guide your clients through your business. The same program was recently presented at a principal broker forum a couple of weeks ago, and afterward, one of those brokers shared that she went into 2 listing appointments that same afternoon, feeling energized and confident and really inspired by what she learned in this same program. So I am excited to welcome our 2 speakers here today. We have Noah Blanton, President of WFG National Title's Oregon operations, and has been a leader in our market since 1998. He oversees a team that closes about 30% of Portland Metro transactions and brings a strong focus on service and data-driven insight. Evan Swanson with Guild Mortgage is a senior loan officer and a certified financial planner with over 20 years in the mortgage industry. He brings a financial planning lens to lending and also serves on PMAR's board of directors and supports realtor advocacy. So Noah and Evan, feel free to tell our audience a bit more about yourselves and go ahead and kick off your program.
Right on. Well, thanks, Diana, and thanks, PMAR, for giving us this chance to do it. And thank you for all of you for taking such a beautiful day to join us. We promise that we will deliver some value to you. And, Noah and I sort of have a back channel communication that we talk throughout the year, and we share economic insights. And one of the things we've always talked about is that, so much time and energy is put into the full year forecast, which oftentimes needs pivoting halfway through the year. And so starting last year, we began this routine of doing a mid-year economic update to kind of check in and see where the economy's at and recalibrate, because as we head into the second half of the calendar year, I think more than ever, having a successful year really means focusing and being locked in for that second half of the year. So no, I just want to say thank you for your friendship, all the expertise that you share with me. And thank you for being here today on this webinar.
And likewise, good morning, everyone. And Evan and I enjoy doing this. It's a privilege to be invited to do it. And we collaborate throughout the year. We're both a little bit of the data geek nerd types. But the point is always to give actionable insights. And I loved the introduction where the hope is that you can take this and use it this afternoon. And I said yesterday, or not yesterday, but at the PB's meeting, our responsibility, I think, as professionals in this business is to provide perspective and give hope, especially when we are at a confluence of markets. Things are changing. There's nothing wrong with that. But as professionals, we should be providing perspective and, hopefully be 6, 8, 9, 10 months ahead of the cycle and able to drive that back into our business and our clients' needs. So I'm excited to be here with you, Evan. Always good to do this together, and looking forward to a good conversation.
Absolutely. Great. Well, let's go ahead and get it going then. We're going to put the slideshow up here. And just for participants, if you guys have questions, please put them in the Q&A. Noah and I will be monitoring that throughout. You may see our eyes shift a little bit. First off, can everyone see my screen okay?
Looks good.
All right, it's the full screen.
It is the full screen.
Great. So put questions in the Q&A. We will take some of those up as we present. We may hold some to the end. There will be a Q&A session towards the end. So as we look at 2025, and Noah and I were recently having a conversation, one of the things that we talked about was that perception seems to be much different than reality right now economically in so many ways. In talking to buyers and talking to sellers and talking to real estate professionals, there's a lot of narratives out there that we think maybe need to be repositioned. And so we focused this presentation around three of those narratives. And again, with the idea of trying to make this as pragmatic or practical for you as real estate professionals, so that you can identify these in your conversations with clients and hopefully provide some rational information to reshape that perspective. So the first narrative that we're hearing, a perception from consumers, it's a bad time to buy a home, right? That's one that we're hearing all the time. We know there's a lot of home buyers on the sideline that are waiting for quote unquote better conditions, and we want to help empower you to have that conversation with those buyers. Another one I'm hearing a lot these days is, well, I'm just going to wait for mortgage rates to fall. There seems to be a prevailing belief that mortgage rates are on the precipice of moving lower. And while that may happen, we don't know that with any level of certainty at all. It's a bad time to sell. So many sellers out there are not selling because they think it's a bad time. And we want to address that. And then we've got a few other variables that we're going to address as well. So let's go ahead and take on the first one, which is that perception number one on the part of consumers, it's a bad time to buy. And I think, the way Noah and I look at this is that the market conditions are such that it's actually a really great time to be a buyer in terms of your ability to negotiate. All right. So why is that? Well, first off, housing supply. And what we know, according to Altos research, is that inventory, or the supply of homes available to buyers, is at its highest level in over 5 years right now. We're back to 2019 levels in terms of inventory. And in working with buyers over the previous few years, I mean, that was the biggest gripe, right? There just aren't enough homes. The right homes are on the market, and therefore I'm not going to buy right now. So inventory is definitely up. And as a result, what we're seeing is it's taking sellers longer to sell. And I know this is a major paradigm shift on the part of property owners right now, because many of them have their, I guess, perception steeped in 2020, 21, and part of 2022. But the reality is the market conditions are such that it's just taking sellers a little bit longer than normal. And as a result, we are seeing the highest level of sellers have to decrease their prices to sell their homes. According to Altos research, currently about 40% of all property owners that are selling in our marketplace have to decrease their prices. And Noah, as we talked about, this doesn't even capture the sellers that are selling at list price, but are likely providing seller credits as an incentive for buyers to buy. So what do you think of all this?
Yeah, no, I agree. It doesn't capture price concession. And the one thing, and we'll look at some of this a little bit later, but the one thing that I think is important to understand is that pricing, the signal that it's sending is not good or bad. And we'll look at a slide in a second here that kind of illustrates that. But what you have going on right now in inventory and pricing is buyers and sellers signaling to each other. And when we're talking about, is it a bad time to buy? We talk a lot about, desire does not equal ability. We'll talk a little bit about that more later as well. I think there's quite a bit of demand for home ownership in the marketplace. Ability is a different thing. Affordability is a separate conversation to address. But the two takeaways and that I would say is what you're really looking at is a market that's recovered from the COVID years. And so we're looking at inventory levels and price reductions that look like a summer selling season in 2019. Does it feel different than previous years? It does, and has felt different. But if you go back to 2022 and some of the, if you drill down on some of the segments of inventory, price reductions were actually higher at certain points in 2022 as we went through the rate increase as well. So I'll build on this throughout our conversation here, but what I see is a market that is finding an equilibrium that looks something a little bit more like a balance of supply and demand. Now, how that feels on the ground is something entirely different, but I think what we're doing is returning to balance. We will watch, as I know all of you will, very closely to see, do any of these lines eclipse the 18 or 19 segments, and that would indicate us moving into a different type of market. But to this point, no. And Elizabeth, I'll address your question as to, is this the opposite of most of the country? And if so, why? In terms, I think, of price reductions and inventory. And I would say that no, it is not the opposite, that the trend is generally more inventory, lower transaction velocity, and a repricing, or at least some sort of renegotiation going on between buyers and sellers. Now, there are certain markets where that's more acute and certain where it's less acute. If you're a condo buyer in South Florida, there is a lot more inventory and a lot more price reductions. So that by market it would vary, but the general trend is that prices are firm. And I'll talk about that too, because I think, yes, we're having some pricing discussion, but prices are generally, we'll look at this in a second and I'll address it more fully, but the characteristics of this cycle are low transaction velocity and stable pricing.
Mm-hmm.
And so
Exactly.
I know we'll address that a little bit more as we go forward, but generally I think our trend mirrors what the national trend is.
One other dynamic, Noah, that I want to point out here as well, as you look at this inventory graph, you'll see that in previous years, as new inventory or new listings grows, February and March, the net inventory actually declines. And this is pronounced in 2020. You can see a little bit in 2024 as well as 2023, meaning that even though new listings is growing in the early months of spring, demand is coming on stronger and that inventory is getting absorbed at a faster clip than new supply is coming to the market. That didn't happen this year, right? You can see inventory remained stable and actually began to increase as we got into March. And that's an interesting dynamic. So net supply is growing, and we can look at this in this slide at the year-to-date figures in terms of listed and pending. And I'm going to let you provide commentary on this slide.
Yeah, any of you that have heard me speak before know that I dislike monthly numbers and think that it's more important in real time to look at weekly absorption rates. And all I would point out in this slide, the blue lines are listed transactions or listed properties, and the orange bars are pending transactions. And we are building some inventory. We built inventory beginning in April. We do every year. And we generally tend to build inventory. Sellers come to the market. They want to move within a certain time frame. But I would certainly encourage you to look at the balance between weekly numbers. Not included, I didn't update this slide, so it's not included, but you will also begin to notice very predictable seasonal patterns. You have a lot of inventory that comes to the market the week after the 4th of July. It looks very out of balance. It catches up with pending transactions. I will share with you that WFG, which represents a decent slice of the marketplace, went into the week of the 4th of July down 20% in open transactions. And we are today down 4% month over month. So you got to watch these things on a weekly basis. Keep your finger on the pulse, and I encourage everyone to look at this weekly. The other thing I would say is, when we talk about building inventory, let's talk about the optionality that comes from a buyer's perspective today. Two things are happening in the marketplace. The very best inventory still sells. The stuff with the least amount of work to be done in the primest locations, and in many cases, there are still multiple offer situations. What you don't have is such a manic level of demand that anything will sell. And the healthy negotiation is taking place around pricing. And that is what is going on when you look at the repricing, and sellers are signaling and saying, we want an offer, we are interested in an offer, and so we're repricing to signal that, and maybe we'll even give some concession. But my guess would be that it is the marginal, not marginal, but the less desirable or the less perfect locations and housing that allow buyers to have a little bit more inventory. To Evan's point earlier, it's a great time to be a buyer to negotiate, and we'll talk more about that. But I think we have to recognize what inventory is having price reductions, and then also what is selling, and that's an important piece of this.
Totally. So, I mean, I think, the gist here is if you're a buyer, these blue lines being above the orange lines is exactly what you want to see, because that means that net inventory is growing, and greater supply means more options and more ability to make offers on different homes and maybe even try and negotiate that. Sellers are now having to compete for your business versus vice versa. And again, what we would have seen in the past few years is these orange lines would have actually been taller than the blue lines heading into about May, in which case you would have seen, that reverse and inventory start to build again. So the point is that we have a lot of supply, or at least a lot more supply than we've had the previous few years, which for a buyer's perspective is great news. Now, coincidentally, that doesn't necessarily mean that we're seeing lower prices in aggregate. And this is, really why we're not seeing the velocity or volume of transactions in the marketplace, because this lockdown effect is real and sellers don't have to sell. There's no forced credit selling, there's no foreclosures, and as a result, home prices are remaining firm. But talk to us a little about this slide, and I really like your commentary here, Noah, about the sold versus list.
Yeah, and so let's look at this slide, and I think it really illustrates the important impact of pricing on a marketplace. And there's nothing wrong with it; it's appropriate, and we should recognize it for what it is, and that's the signaling of buyers and sellers to one another. So here's what this graph represents, and some of you have seen this before, but the orange line is the median price, January of 20 through June of 2025. The blue line is the average percent to list, sold over or under list price. And it looks like I mislabeled that gray line going straight across, but that gray line going across equals 100% of asking price. So COVID hits, rates get driven down, and you see this dynamic where the median price starts to go up. And rates are going down, prices are going up, and in May, June of 2021, buyers are paying 105% of over asking price. And what's going on here is buyers are signaling, we're willing to pay more. We can pay more. We're willing to pay more. Bring more inventory to the market, and we'll pay you more. And they're driving up the signal, which is median price. We do that again in 2022, where we drive the median price up to 106% nearly of asking price. And then rates take an effect and buyers capitulate. They say, we're not willing to pay more. We cannot pay you any longer. And so what happens? Median price moderates. The negotiation goes back down to a seasonal pattern, which says buyers pay less on average of the asking price in winter and more in seller. This is a very normal seasonal pattern. And what you don't see after 2022 is the median price deteriorate. That's pretty flat. So this goes back to the article that was put in the chat box a little earlier, low transaction velocity, firm pricing. And yes, we did. This is only the metro area, Kurt. So we are just talking about metro area pricing now. I want you to pay attention to the blue line going forward. So think about this as sort of energy coming out of a stone you've skipped or a ball that you've thrown. And you sort of see price negotiation, stabilization, and then look at where we are today in June, where on average, sellers are accepting a little bit less than their asking price, even at a median price that is near all-time highs in the metro market. So in my mind, what does this look like? Really healthy price negotiation on both sides of this cycle. We cannot complain about the price signal that was sent in 21 and 22, or I'm sorry, we cannot be happy about that price signal because it was going up and complain about the price signal that's being sent now. This is a really dynamic, important buyer and seller communication that is going on in the marketplace right now. What can we pay? What will we pay? Buyers and sellers reaching their point of price capitulation. And I'll wrap this slide up by saying this. In 2008, the inputs to the 2005, 6, 7, 8 cycle were high transaction velocities, low down payments, poor credit scores, variable rate adjustable loans, and little equity in your home. And the output was falling prices, high transaction velocity, huge foreclosures. The input to this cycle has been still lower transaction velocity than the 05, 6, 7 cycle, highly qualified borrowers, larger down payments, fixed mortgage rates. And so what's the output? Low transaction velocity and high pricing. This is not a surprising result of this cycle given the inputs to the last cycle. And so what I see is a fairly healthy repositioning of the marketplace, minus the transaction velocity, which I know we all want to get back, and we'll talk about that a little bit more later. But pricing, in my mind, looks like it's it's finding a healthy equilibrium.
Right. And so just to clarify for anyone wondering, transaction velocity just means the volume of transactions, the number of transactions that come together. And that's obviously low right now. So yeah, but so if we're talking about helping buyers understand the market and the reality versus their perception, I would absolutely highlight this slide, and I would absolutely share this with all those sideline home buyers that you've talked with over the last year, because and I do this every single year. I keep a list of all the home buyers that I've engaged with who have not purchased to date. And around October, I reach out to them and I share this graph and say, hey, listen, if you're still interested in buying a home from a seasonal perspective, let's get ready and let's go. And the reason for that is because you can clearly see that more homes sell below list price during the winter months than during the spring. So from an opportunity perspective, I think seasonality matters. And for those buyers that can make that transition during that time, it can really be an opportunity. Now, we talked earlier about seller concessions, and this is a table I put together for a listing realtor in the spring, and they had a modest house listed in Northeast Portland for $450,000 that was having trouble selling. And I often have this conversation with buyers is to say, hey, if you see a home that's been on the market for a while, your natural intuition is going to be to say, well, what if I can get that home at a lower price point? So in this example, the home was listed for $449,000. And based on where rates were at that point in the year, the monthly payments were going to be about $2,870, including tax and insurance for this situation. A buyer that would come in and say, well, this house has been on the market for a while. I'm not going to offer full price. I'm going to offer $10,000 less. The practical impact to that buyer is the monthly payments are only about $65 per month, which for most buyers is not going to move the needle in terms of their ability to afford that home. And so, one of the tricks that we can look at is to say, well, you know what if we took that same willingness on the part of the seller to use that $10,000 and as opposed to spending that on a price reduction, let's use that towards buying down your permanent fixed rate. And so, in this example, we're able to take the home buyer's rate down by 0.625%, which decreases the payment by $150. So using the same $10,000 that the seller is willing to pay, we can have basically a 2.5x impact to the buyer's monthly payment. And if we're talking about an environment where Noah touched on the inputs being stable prices near all-time highs and high interest rates, we really need to come up with creative solutions to figure out how to drive down the payment if we're going to help buyers and try to increase that transaction velocity. One other thing that you may try and think about, and this is sort of an exercise I run through with buyers, because all of us have had interactions with buyers that are uncertain or not sure or fearful about buying a home in the current environment. And I say, listen, let's imagine for a second that you buy a house today, okay? And if we're talking about a market in the future where homes are going to be more affordable, then we're talking about two inputs or two variables. We're talking about mortgage rates and we're talking about home prices. All right. So let's say first off that you buy a house today and in the future, mortgage rates rise and home prices rise. Well, then you would look back and say you're better off buying now than you are waiting. Okay. All right. Let's look at another situation. You buy a house today and in the future, mortgage rates fall and home prices rise. Well, I would argue you're still better off buying today because we'll refinance you into that lower rate and lower payment, but you would have been able to buy the home before the prices rose. So in 2 out of 2 cases, a buyer would be better off buying today. In the third scenario, you say, okay, you buy a house today and in the future, mortgage rates rise and home prices fall. Now, this is the buyer that bought in 2021, right? So yes, home prices may have fallen a little bit since they purchased, but they have a benefit of having a lower interest rate and therefore a lower payment. And I would argue that many of those buyers who plan on staying in their home long term are still better off, even though they had to pay a little bit more for the house, because they have a very low rate and very low payment. So in that case, they're better off buying now. The only scenario where a buyer is worse off is if they buy a home today and in the future, both mortgage rates fall and home prices fall. But the question I ask the homeowner or the home buyer is I say, hey, how likely is it that we're going to see home prices fall if we're in an environment where mortgage rates are falling as well? So if the future truly is uncertain, meaning we don't really know what's going to happen in the future, what we demonstrate here is that in 3 out of 4 cases, that homeowner is better off buying a home today than waiting. And the one case that they're not better off in is kind of improbable because of the unlikelihood that prices fall in a decreasing rate environment. So that's another little game you can play or questions you can ask to help your homeowners better understand the possibilities here. All right. So let's move on. Oh, go ahead, Noah.
Evan, in the mortgage rates fall and home prices fall box, just put buy rentals.
Yeah, there you go. There you go. Exactly. Exactly. Okay, perception number 2. We've all faced this buyer as well. You know what? It's unaffordable. I'm just going to wait because mortgage rates are going to fall. I think that this is a widely held belief right now, not only amongst consumers, but I think if I even took a poll of the participants in this call, an overwhelming majority would say that that is absolutely true. And it might be. There are plenty of narratives out there that we'll talk about that would lead mortgage rates to be lower, but it's not guaranteed. And so what we want to sort of help people understand is that the way our minds work is convincing us that interest rates are high right now. And I would argue this is really based on recency bias and maybe even optimism bias on the part of real estate professionals. So this is a chart of the average 30-year fixed rate mortgage going back to 2011. So this goes back, 14 years, and this is the way that our brains look at mortgage rates, right? So from 2011 to 2022, mortgage rates oscillated between 3 and 5%, right? And then in September of 2022, mortgage rates finally convincingly moved above 5% and even into the 6% threshold. And since then, we've been between 6 and 8%. So for a majority of the last 15 years, interest rates feel high right now. It's an outlier. And therefore, we would expect reversion to the mean, meaning that mortgage rates would come back down into these low levels. But the reality is that 2010 to 2022 timeline is the outlier, right? Mortgage rates historically have been higher than that. And we just lived through a period where mortgage rates were historically low for a very long and prolonged period of time. And I would argue have distorted consumers' expectations around interest rates. Noah, anything to add to those comments?
No, and we'll talk a little bit more about maybe some of the technical reasons that the interest rates are where they were for that period of time, and then that may also influence where they go in the future as well. My only comment would be that I really liked that period of time better than the one we're in now. That was great.
Absolutely. So I think consumers need an education on how mortgage rates are determined, because I think the mass media does a very poor job of correlating mortgage rates to the federal funds rate, the rate the Fed actually controls. Fannie Mae issued a great paper in November of last year that explained to the public how mortgage rates are determined. And there's a pretty tight correlation between the yield on the US 10-year Treasury note. So that's an interest rate that's dynamic. It trades every single day and that yield moves up and down. And then on top of that, there is a spread between the 10-year Treasury note and mortgage rates. Part of that spread is simply the cost of originating a mortgage loan, right? The secondary aspect of that spread is the reality that lending to a household, an individual, is just fundamentally a more risky prospect than lending to the US government that can create its own currency, right? So generally speaking, there is a roughly 2% spread between the 10-year Treasury note and mortgage rates. Now that spread is wider right now. And here's a chart that shows the spread between the 10-year Treasury note and mortgage rates dating back to 1990. Now, again, historically, you can see that most of the time, the spread between the US 10-year Treasury note and mortgage rates is actually sub 2%. But during periods of volatility and during periods of uncertainty, you see those spreads widen. And again, this fundamentally there's a variety of reasons for that. But ultimately, no matter what happens, the US government can literally create its own currency to repay its debts. Okay. Households can't do that. And so as a result, the premium that someone lends to a household is always going to be a little bit higher. Now, this spread currently in our current marketplace is just under 2.5%, which is not as high as it was, just a few months ago, but it's still pretty high. And if we saw these spreads normalize, meaning that if the interest rate market or the yield on the US 10-year Treasury didn't move, right off the bat, mortgage rates would be 0.25% to 0.5% better. So Noah, what other comments or commentary could you add to this?
Well, all I would add is that this is sort of one of those self-serve things that everyone can watch for themselves, is that spread between the two. But I would just point everyone's attention to the trajectory after we've gotten some of the inflation under control and the downward trajectory as that spread works to normalize. There are a lot of positive things going on. The recent passing of the tax bill, some of the trade deals that we're getting that help the marketplace understand what the market wants more than anything is certainty. And they'll even take bad news certainty. They just want to know what's coming over uncertainty. And so I do think that you see a normalization of risk in the marketplace. The volatility indexes across some of our equity markets are beginning to stabilize. And so I would expect that we do see this come back into a more normalized range. It is one of the things that we watch and is a hopeful sign for mortgage rates. We can take, as Evan said, 1/4 to 1/2 point off the mortgage rates without anything else happening once we, I think, stabilize the spread and the risk is known in the marketplace. So this in my mind is a positive and a place that you can all watch for yourselves to know what direction you think mortgage rates are going.
Yeah, absolutely. So we'll keep an eye on this, but I think if we do see the financial markets calm down, if the degree of uncertainty, goes down, which, as we acclimate to this new world, should happen. We should see rates improve, even if the yield on the US 10-year Treasury does not significantly improve. Now, speaking of the 10-year Treasury, when we talk about historical mortgage rates, the reality is that the Freddie Mac Primary Market Survey is the one that the media and even many industry professionals rely on as a metric for mortgage rates. The problem with that is the primary market survey from Freddie Mac only goes back to 1971. And within that time window, you've got, the late 70s and early 80s with super high inflation and super high interest rates. And then, of course, you've got 2010 to 2022, which I would argue distorts the averages lower. So if we know that mortgage rates tend to be about 2 points higher than the US 10-year Treasury note, I think it's more productive to grab a larger sample size. And we have very reliable data on the US 10-year Treasury note dating back all the way to 1879, 150 years worth of Treasury data. And if you take that data, the average long-term historical yield for the US 10-year Treasury note is 4.48%. So add the 2-point spread for mortgage rates, then homeowners, in my judgment, should expect that a normal 30-year fixed rate mortgage is about 6.48%. And so again, if right now the mortgages are around 6.7, 6.8, 6.9%, and we know those spreads have widened, and so if we get the spreads to compress down another 0.25%, then really the interest rate environment right now is in line with a long-term historical average. And so helping homebuyers understand that mortgage rates are not necessarily high right now. It's that our minds have been conditioned to think that 2010 to 2022 was normal. And in fact, that was an outlier. Now, it's also worthy, I think, to note that, just because this is the average, there's always going to be dispersion around this. And so at some point in the future, I think we could expect that mortgage rates will be less than 6.5%, but that may not be in 6 months or a year or 2 years. It could take 5 years. We just don't know for sure. All right, so let's Noah, shift gears and talk a little bit about the Fed, because we know the Fed has an influence on the market. And here's a picture of Chairman Jerome Powell with our president. And I'm just guessing this picture was taken a while back, given the smile on Trump's face. But who knows? So let's look at the Fed here. They've got a dual mandate, and the Fed's dual mandate is to maintain price stability, which i.e. is inflation, and also maximize or generate full employment, right? And full employment doesn't mean that every single person in the United States has a job, but generally speaking, they want to see the unemployment rate hover around 3.5 to 4.5%, okay? So let's take a look here, and we're going to start with the Consumer Price Index report, which is one of the primary measures of inflation in our economy. And what this chart shows is, first off, the Fed's target being 2% year over year. That's the green dotted line here. And the blue line here represents the core CPI, meaning that they strip out volatile food and energy prices and measure the price changes in all the other goods in that basket that they track. The red line being the headline inflation number. So right now, as of most recent current readings, the headline CPI is about 2.4% year over year. Still above the 2% target, but certainly substantially less than where we were a couple years ago when inflation was 8-9%. Now, the core inflation reading is still about 2.8%, so nearly 3%. So again, above their target. But the important thing in the way the trend is going is that it is trending lower towards that 2% target. Now, this green dotted line measures within the CPI basket of goods that they track. They look at shelter, aka rents. And that particular reading within the CPI index is still coming in pretty high, about 4% year over year. And you can see that this particular price metric tends to lag other measures of price changes in our economy. So Noah, why is that? Do you want to provide us a little commentary here on what we're looking at and why we're seeing this?
The rents lagging behind.
Yes.
Yeah. Yeah, rents are it's a funny equation, and the owner's equivalent rent survey is what the Fed uses to track the inflation in housing or in shelter. And so it has about a 12 to 14 month lag behind what's actually going on in the marketplace, because the question that they ask a homeowner is, and they actually call and ask this question through a survey, believe it or not. And the question is, if you were to rent your home today, the home you live in, or an equivalent home, unfurnished and without utilities, how much would you expect to pay? And some number of homeowners answer this question, and then they impute an inflationary measure to shelter. And what you generally see is both rents, real world rents, if we're actually talking about rents, because we're not actually talking about mortgages here, you will see them start to drop 9 to 12 months ahead of this survey drop. So there is a decent lag time behind that. And so we're always looking for where that's going and then trending out into the future. I think Evan mentioned that this is 26% of the weighted average of the CPI. So getting shelter inflation down, or 42% then of core, getting shelter inflation down ends up being really, really important to getting shelter inflation overall down. And this is, I'll just talk about this one real quick, Evan. This is a inflation by category for the previous month and then the current month. So you're looking at the prior and the current month. All items are on the left-hand side at 2.4%. This is the headline number. And then you can see those different categories that are inflating or deflating, and you can see where shelter is. And it's stuck at a level higher than we would like to see. We'd not like to see shelter inflating near the 4% range, and it has a big influence on inflation overall. The other thing you might notice is energy and gasoline are where we're getting a lot of pickup deflationary pressures and bringing overall inflation down a little bit. Fairly volatile measures, and that is why we strip those out in the core of CPI. But we have modest downward pressure on inflation, but it's slow, a little slower than I think we would like to see.
And a lot of uncertainty in that space right now. Here's a look at the Fed's favorite gauge of inflation, which is the Personal Consumption Expenditure Index. Pretty similar numbers here. You've got the core increasing at 2.7% year over year headline. What's more important than specific numbers here is the Fed is looking at this and saying, hey, it was only a couple years ago that inflation was running, over 5% per year. This is moderating. And, when a company or a landlord or someone raises prices, it's a ratchet effect, right? A ratchet only tightens, it doesn't loosen. And so you're not going to see many companies willingly lower prices after they raise them. And what we're trying to figure out is, where's the stable place? The Fed is not as concerned about inflation at the moment. And I did see here Andrew ask the questions about deficits. We're going to get that. We're going to get to that, Andrew, later on in a different slide. But this is a really, really interesting fact in this slide here, Noah. And you're the one that brought this to my attention, so I'm gonna give you the chance to talk about it. But talking about perceptions and reality, go ahead and explain this one.
Yeah, so there has been, let's say that the last 6 months has been fairly chaotic. I think it has been very difficult for us as consumers to orient ourselves in a future expectation of pricing. This morning we had tariffs, this afternoon we don't. They're 150%, they're 2%. It is a very difficult line to follow on what's actually going on. And we're passing a tax bill, and the tax bill looks like it has deficit spending attached to it. And the consumer is having a difficult time, I think, orienting themselves in their expectation of future prices. And so this slide represents that. And I think it's worth pausing here and thinking about this. So let me just walk you through this. 2020 on the left-hand side through last month on the right-hand side. And you're looking at actual inflation, which is the orange line, and what the consumer expects inflation to be in 1 year from now. During COVID, the consumer, we're the consumer, I'm talking about them like they're not us, but we are, that we expected that prices might inflate, inflation might reach 5%. It eventually reached nearly 9%. And we still thought it would be 5% a year from now. So we're a very hopeful group. We have this point at which we think prices will not go beyond. Inflation comes down very rapidly, and we have this nice period of time where inflation matches our expectation. So we are experiencing inflation at about 3%, and we think in a year inflation is going to be about 3%. What is important about this period of time? It means we can take action. As consumers, we think we know how to plan. We think we know what the future holds. We think we know what to expect. And so we say, all right, let's go ahead and take action. I just want you to look at what happened in the first 6 months of this year. Consumers' expectation of where prices would be in a year went to nearly an all-time high. Consumers decided, you know what? I don't know what's going to happen, and so I'm going to expect the worst. I think prices are going to 6.6% inflation in a year. And what prices actually did for the first 3 or 4 months of this year is continued to come down. They've turned the corner and inflation's starting to go up a little bit. But here's my suggestion, and this has already happened actually in the latest read on inflation, consumer expectations. It's come back down to 6%. That number is going to continue to come back down while the short-term actual inflation is ticking back up. Those two lines are eventually going to meet again somewhere where actual inflation meets the consumer's expectations. Here's my suggestion. In this marketplace, part of what we need to do is help provide consumers perspective on real estate and real estate pricing specifically. And I would say that this slide represents a lot of opportunity for education. Consumers are fearful. They are afraid of what's coming or what may potentially come. They don't know how to decision. There's some anxiety around what a very significant change in tax policy means and the chaos of the way tariffs are being implemented. I won't speak to whether that strategy is good or bad, but from a consumer's perspective, it's chaotic. There is opportunity in the disparity here and how consumers should act and how we can educate them. Watch this as it comes back together. It will indicate a mood of the consumer and when they're ready to act again. I think this is a really important indication of how consumers feel, and in fact, how many of us may feel right now as well. It will moderate and come back down over the next 3 to 4 months.
Great stuff. Nice job, Noah. So bottom line is, inflation is headed in the direction the Fed needs. So going back to the dual mandate, inflation, employment, job growth remains steady. The U.S. economy has been proven resilient. I mean, there's many other countries out there that are frankly jealous of the performance of our job creation. And so you can see this is the month-over-month reading of the number of new jobs that our economy has created. According to the Atlanta Fed, we need about 110 to 115,000 new jobs per month to keep the unemployment level even. So without letting the unemployment rate rise. And you can see for the first few months of the year, we've been above that mark, right? So unemployment is actually coming down a touch. The job market remains resilient. And so, until you see this change, the Fed is not going to change their tune. Here's the unemployment rate hovering around 4.1%. It actually has decreased a little bit in the last month or two. Again, showing signs that the employment side of the market remains strong. This is going to be the canary in the coal mine, and these are the economic indicators that I'm watching. Until we see employment break lower, the Fed is not likely to take their foot off the gas in terms of letting interest rates decline. All right. So the blue line here represents the number of job openings in our economy. And you can see here that we still have nearly 8 million jobs out there for a person who's looking for a job to consider. And initial jobless claims, this measures the number of people that are filing for jobless claims, unemployment benefits for the first time. This is measured on a weekly basis, and this is still firmly under 300,000. It's about 225,000 right now per week. Until this number gets over 300,000, it demonstrates that the employment market is still very stable. I know that the local dynamic around that is different. These are national numbers, and we will talk about the local here in a later slide. But bottom line here is the employment market remains strong. And so the Fed's got a conundrum right now. First off, there's a lot of uncertainty around tariffs, and tariffs are inflationary, at least on a one-time basis. And the Fed wants to fight inflation. So they're not likely to let interest rates move lower unless they have certainty around what inflation is going to look like. Tariffs also will likely adversely impact economic growth and employment. So, they're looking at the impact of that as well. And to Andrew's question earlier, fiscal policy is still highly expansionary, meaning deficit spending. So the government is spending about 6 or 7 cents on top of every dollar they collect from the IRS and tax revenue. And that's we're having to finance that through higher deficits and higher treasury supply. So as long as the government is spending a lot more than they're taking in tax, that is expansionary in terms of the economy. And that mutes the ability of the Fed to slow down or even fuel the economy if they need to. So a lot of different things here, and what's the Fed going to do? Well, according to the way derivatives change trade right now, so this is, hundreds of millions of dollars betting on this. The current expectation is that there's roughly a 70% probability that the Fed will cut by a quarter in September. And then they will wait a meeting and likely cut again at their December meeting. But what I want to point out here is that for the entire cycle, the markets have over forecasted Fed rate cuts. So again, these are the expectations as of today, but I would not be surprised if we only get one or maybe zero rate cuts from now until the end of the year. No, any thoughts on that?
Yeah, I have two thoughts on it, and this may be an unpopular opinion, maybe not, but I am sort of a defender of the Fed in this environment. I think they have acted judiciously and prudently. I would just remind everyone that the Fed has already lowered rates by 100 basis points, and they did that last September. They are through their rate rising and tightening cycle, and they are in a long-term moderating and easing cycle. But I don't necessarily think that significant rate cuts are appropriate right now. I do think that they may be in the future, but the Fed does have a difficult tightrope to walk, and that is full employment, still getting inflation under control, which is not where we need it to be yet, and a government that is running at present, as did the previous administration and the administration before, equal opportunity here. They are deficit spenders, and that piece will eventually need to be addressed. So I am a supporter of what the Fed is doing. And I think it's an appropriate ballast to some of what's going on in the market. And I am confident that if employment were to deteriorate, or inflation or growth were to come down significantly, we would get some action from the Fed. There is some anticipation of significant GDP growth, which is fantastic, and some anticipation of continued job growth, also fantastic. Both of those things will offset higher rates. So that's my only comments there.
Great. If you ask the Fed, this is their dot plot projection. They expect to cut rates in the years ahead. Obviously, this can change, but the bottom line is that the Fed, in their own opinion, it believes that short-term interest rates, anyways, will be lowered. This graph, Noah, has far more impact on the direction of mortgage rates than does the federal funds rate. And Bill, good question in the Q&A there. This really is such a unknown fact on the part of the American public and even amongst real estate professionals. And yet it has such an impact of what's going to happen moving forward in terms of mortgage rates. So what is this? This is a graph that shows the holdings of the Fed in terms of mortgages that they own. All right, mortgage-backed securities. So understand that when we had the housing crash back in 2008-9, this had never been done, but Ben Bernanke, the existing head of the Fed at that time, basically said, hey, we've cut rates. We're doing everything we can. We need to do more to stimulate buyers in the real estate market. And he began to consider, well, instead of the Fed owning treasuries, what if the Fed just went out and bought mortgages? And so starting in 2009, the Fed acquired mortgages for the first time in their history. And from 2009 to 2011, they acquired $1.2 trillion of mortgages. Now, why did they do this? The reason is because the Fed has such a significant purchasing power or demand in the place for mortgages that they can drive down interest rates. Also keep in mind, the Fed is not profit driven. So they're not necessarily concerned about the return on buying mortgages. They simply want to stimulate buyers in the real estate market. And so what happened? Well, mortgage rates declined. They went under 6%. And as we know, from 2010 to 2022, mortgage rates were, 3 to 5%, and in some cases, sub 2% during COVID. Now, why was that? Because the Fed kept adding to their holdings. That all stopped in 2022 in July. And at that point, the Fed said, okay, enough's enough. We're not going to buy any more mortgages. From 2020 to 2022, the Fed added another $1.4 trillion to their balance sheet. And by many estimates, they were funding roughly 80–90% of all mortgages originated in the United States during that window. And think about it, if you're running a bank and you are looking at taking the deposits from your depositors and earning a return, and you realize you may have to hold that mortgage for 30 years, why on earth would you buy a 2.5% 30-year fixed rate mortgage when inflation is projected to run higher than that? And the reality is many banks didn't, except two. And those, of course, were Silicon Valley and First Republic, which are no longer with us, right? So that's the side of decision that those banks made. Only the Fed could do this, right? Okay, so we get to 2022 and the Fed says, hey, we're not going to buy anymore. And as a matter of fact, we're going to let these mortgages run off our balance sheet so that every time one of you sells a home and that homeowner has a 2.5% or 3% mortgage, chances are that money is going back to the Fed, right? Because they are the ones that own that mortgage. And what the Fed is doing is just letting that money evaporate into the ether, right? They're not reinvesting or buying another mortgage with it. They're just letting that run off. And so you can see that right now the Fed is allowing $35 billion per month to run off its balance sheet. And that's partially why mortgage rates have been, moved higher. Now, what's interesting about this is that the Fed also holds quite a bit of US Treasury debt. And back in April, the Fed announced that they were going to reduce their redemption cap from $25 billion per month to only $5 billion per month. So what does that mean? That means that if the Fed receives $25 billion in redemptions during a month, prior to this change, $25 billion would simply just run off into the ether and be gone. But now, if they get $25 billion of redemptions from treasuries being paid, 20 billion of that is being reinvested back into the treasury space, which is demand, which is helping to drive yields lower. And that's maybe potentially why we're seeing the spread widen again between mortgages and treasuries. So the question is, will the Fed also apply a reduction to their redemption cap for mortgages in the coming months? And if they did that significantly, then we would likely see mortgage rates improve off the bat. Because what would happen is instead of this running down at this decline, it would probably stabilize like it did during this window of time. And that would be additional money coming back into the mortgage market, which would drive yields lower. So, Noah, with all that, what do you want to add to that?
No, well said and explained. I think 2 points I would bring up. One, whether we like it or not, we do not function in a purely market-driven mortgage market, and we haven't since 2008. The Fed can lower rates anytime they want on the 30-year mortgage. All they have to do is engage in significant buying of MBS, and they can bring that rate down. They have that tool to really directly influence. So whether we like it or not, I would say that the Federal Reserve is happy with where interest rates are today, largely because it holds housing inflation in check. How does it do that? Low transaction velocity and tamping down on price increases. I would say that as painful as it is for the real estate market, the Fed is accomplishing their goal here. And they can lower rates when they wish to lower rates. And then the other piece I would say is, for all of the grief that the Fed gets about not lowering the overnight rate, this is another illustration of them coming into that easing cycle with different tools that are available to them And as Evan illustrated here, the lowering of the redemption cap is another illustration of them moving into an easing cycle. So they are doing different things using different tools that are available to them to adjust to the economic cycle that we're in. And they have a lot of influence here. Unfortunately, they're happy with where 30-year mortgage rates are at the moment, but they have a lot of influence.
So for those buyers who are waiting for rates to fall, here's the ways that we see mortgage rates improving in the tail end of 2025, which, by the way, I don't think Noah or I necessarily think is going to be significant. But
yeah.
If the Fed should come out and say, hey, we're going to reduce that redemption cap to a significant number, that would help mortgage rates improve. If we saw continued normalization of spreads between mortgage rates and treasuries because uncertainty and economic volatility begins to subside, that would help mortgage rates. And that's probably the most likely scenario, Noah. And then number three, as we enter into a recession, and like any good economist who's predicted 10 in the last 2 recessions, who knows? What's not included here is lower deficits, because there doesn't seem to be any political will on the part of either politicians or voters, for that point, to lower deficits at this point. And you also notice absent is the federal funds rate, because the expectation that the Fed will cut rates is already built into mortgage rates today. So that in and of itself, that will not change anything. Okay, perception number 3, it's a bad time to sell. I'm sure many of you are having these conversations with sellers right now. And, much like we had to prepare buyers in 2020 and 21 to go to battle and compete with other buyers in the marketplace to buy a home, I feel like we're doing the same thing with sellers right now. Real estate professionals are doing their best to set those expectations, to get them ready and say, hey, you know what? It's not 2020, 21. You're going to be competing with many other sellers. So no longer can you bring a bad house to market that's priced inappropriately, that doesn't look good, that's not polished. If you do that, there's enough slack in the marketplace that you're going to sit. So I think, the opposite is in that opposite market right now, where it's now really adjusting sellers' expectations to say, hey, it's a different market. Now, that said, transactions are still happening. So the point here is that, listen, Noah here aren't going to tell you it's a great time to sell, but it's not necessarily bad. It's just a different or more normal market. And I think sort of trying to reshift sellers' expectations to understand that what we're going through right now is a much more balanced, normal market is what it is. And, some of the positives out there. Well, first off, age demographics could not be better. And all of us should thank our lucky stars that we went through 2023, 2024, and now 2025 in a period where mortgage rates went from 3 to 7%. Affordability took a huge hit. All these homeowners have low mortgage rates. They have a disincentive to sell. Thank goodness we had the millennials reaching their peak home buying years in that window of time. And that's still the case. Roughly a third of the Portland population is between the age of 25 and 40 years old. And home ownership rates go from about 38% to 61% at the age of 35. So what we know here is that there is still a lot of demand for housing purely based on age demographics of our population. And despite the fact that we really haven't seen a huge change to the dynamics or the affordability in the marketplace, according to the Mortgage Bankers Association, mortgage purchase applications are up 40% from January to July. And by the way, this is seasonally adjusted data. So this isn't just the market. This is seasonally adjusted data. And the bottom line is there are more and more people applying to buy a home and test the market. So Noah, any thoughts around that?
No, well said. I think those are positive indicators. And the only thing I would add, after saying I wasn't going to add anything, is those demographics, for perspective, in the metro market are some of the best in the country. So in the last cycle, the large population growth and economic cycle that Oregon and the metro market went through 2015 through 2019, we added a lot of young people and a lot of jobs. And that will be very positive for us as our population growth moderates from migration. That inbuilt demographic is going to be extremely helpful for the demand side of this equation. So they are some of the best demographics in the country.
Absolutely. And if you are a seller and you're thinking about supply relative to new home construction, what we know is that builders are pencils down right now. There's not a ton of activity, both for building for rent or for new construction for ownership. Permits are down, and this is the cycle. Noah, you can see it here. The cycle continues. The pendulum changes. Help us understand and contextualize this in terms of what this means for market dynamics 1, 2, 3 years down the road.
Yeah, and this is, I do think, some of the positioning and perspective that is important to give to home buyers and sellers in the marketplace. This is the leading edge of supply in our market. And if you look back prior to the Great Recession, single-family residential is the orange line, and then stacked on top of that would be multifamily, 5 units or more. We have never at any point in time in the metro market put the same number of single-family residences in the marketplace as we did prior to the Great Recession. What we did do is put the same number of units in, but those units were multifamily, and it's where a lot of those young people moved into in that 15 through 19 time period. It made sense. Rates were modest. Rental rates were climbing, vacancy rates were falling, and we sort of fundamentally changed the supply of housing in the marketplace after the Great Recession. What I would point out is that in terms of putting new units in the market, either single or multifamily, new construction, the front edge of supply has been falling since 2022. The projection is that 2025 number is not a projection. That's the actual through May. The projection is that we will put fewer single-family residences and much fewer multifamily into the marketplace because it's very hard to make that pencil. So the leading edge of demand is not, or the leading edge of supply rather, is not more supply. That new supply is actually looking like less in the next 18 to 24 months. The implications of that are renting is going to get more expensive as scarcity returns to that market. And what will happen to rental rates? They'll have to go up in order to account for that. So in both Portland and actually Vancouver now, they just announced an SDC waiver. Portland announced an SDC waiver on new construction as well. They are trying to stimulate supply. The municipalities can read this same chart and say, wait a second, we're going to put less supply into the market. The positive for existing homeowners is that's going to mean what? Stable pricing. And I think that SDC waivers are good. There's nothing wrong with that, but they're temporary. So it only helps to stimulate in the short term. And quite frankly, I think at this point in the cycle, they're going to be less effective than they would have been 2 years ago. Builders are cautious and unwilling to get out over their skis here. We also have, someone mentioned earlier in the chat, construction supplies are expensive and getting more expensive. There is some influence in different parts of the construction process from the tariff implications. And so there's a lot of, new construction is not going to get less expensive, although builders have done an amazing job at buying down and trying to make their product more approachable. But on the leading edge of supply, do not expect that there is more supply coming on the new side in the next 24 months.
Yeah. And we could also put the slide in the buyer section too, because again, if someone's not going to buy now, I think the reality here is, you might be subject to higher rents in the coming years based on this. So the cycle continues. Listen, the population is not growing as rapidly as it did during 2010 to 2020. And in retrospect, I think that was sort of, an incredibly incredible performance on the part of our city and our state in that window of time. I don't think you could expect that to go on forever. But the good news is our population is growing again, both in Oregon, as well in Portland as well. So more modest growth, but we still have net immigration to our city. And, with all the challenges our city has, there's still lots of reasons why people want to live here. Now, within that, of course, we are seeing net migration out of Multnomah County, and that's just a reality. This is a dynamic that we've seen now for the last 4 years, probably not going to last forever, but here we are, Noah.
Yeah, let's just face the reality on the demand side. We have wonderful demographics, so that is good. We should be grateful for that, but we are in a much more modest inbound net migration cycle than we were in the last, that 10 to 19 range. And you can see people vote with their feet. They respond to incentives. This is what we would call the COVID migration. And there is some, COVID effect here. Lots of urban areas lost people during COVID. The issue would be today that Multnomah County continues to lose people, not yet fully recovered. Natural increases on the left-hand side. This is births minus deaths. Clackamas blue, Multnomah orange, Washington County gray, and then net migration 20 through 24. Clackamas, Multnomah, and Washington. You can clearly see the trend there. You understand why that is the case. I certainly think the county and the city are working to address that. I will say from a tax perspective, there is some great incentive at certain income levels to exit Multnomah County. One of the positives for high personal tax rate states like Oregon in the tax bill that just passed is the SALT deductions moving from $10,000 to $40,000. That will be helpful to residents of Oregon. And you're going to talk about that. I'll let you talk about that. But we need to recognize that we're in a modest demand part of this cycle and come to just deal with that head on.
Yep. And the only reason I switched over, I didn't mean to cut you off there, but is that,
Yeah.
who's leaving Multnomah County? The evidence is fairly clear to your point. There is now a tax disincentive for high income earners to live inside the city limits. And just as a reminder, the Preschool for All program levies a 3% tax on high income earners. And then the Metro's housing services, which obviously applies to the Tri-County area, is another 1%. But Oregon already has a pretty high marginal tax rate for high income earners. So you're just stacking that on top of that. And I think when people get their tax returns back from their CPAs, they begin to go, well, wait a minute, what are we doing here? So at any rate, it is the reality. And you can see that there's more people. But to your point, Noah, one of the good things about the OBBBB is that SALT deduction increases. So at least for those with AGI of $500,000 and below, at least those taxes are now deductible, because prior to that, they weren't even able to deduct those taxes on their federal tax return. Employment recovery. This is a really important part of the conversation here. And obviously the employment picture here in our region now is a little bit concerning. And so, no, I'll let you handle this one.
Yeah, we're also talking about, a moderating demand cycle in the metro area, and the state and the metro are in a different part of their economic cycle. Prior to COVID, this is employment, the percent change from 1 year ago. So how fast are we growing jobs? 2015 on the left-hand side. And the Portland Metro was an overperformer for that 15 through 19 immigration cycle and economic cycle. We were growing jobs at a faster pace than the nation was, which is the orange line. You get a big drop in 2020. We understand that. We understand why. You see the recovery come back. And now you look at 23 through current month 25. Oregon is lagging behind in job creation. It's not that we aren't creating jobs. We're just not creating them at the same pace as we were 15 through 19. And this sort of zooms in and illustrates that point. Oregon growing jobs at about 0.4% rate year over year, the nation at about 1.125%. We are in a more modest cycle. And what's the number one people tend to migrate? A job. And so those two things sort of go hand in hand, a more modest cycle. One of the things that COVID masked, I think, in Oregon, and this is unfortunate, but one of the things that it masked was the implementation of the CAT tax in the state of Oregon in 2019. And the CAT tax is a commercial activity tax, which is essentially a gross receipts tax, whether a business makes money or doesn't make money. And we would have seen, I think, the signal would have been clearer as to the implementation of that tax had we not had the COVID period of time. But there's, sort of this confluence of factors that I think is leading to a little bit, not a little bit, significantly lower job growth in Portland and the state than the country as a whole. And we'll have to address some of those things in terms of the incentives to create jobs or bring jobs here, and whether it is an attractive place to place capital going forward. And that is for the leadership of the state and the municipalities to wrestle with.
Yeah, and we need to win. So anyone who can bring a job in, we need to win right now, besides Dame coming back. Home prices here in the Portland market, they're still increasing, granted at a declining pace. And I would say if there is a message to a seller here in terms of helping them understand, hey, now again, this is not home prices, this is home price appreciation. So as long as these lines are above the median line here, that means prices are increasing. They're just increasing at a decreasing rate. But if you look at this trend, if that were to drop below, that would mean that home prices are actually declining. And so for a seller that's interested in selling, the question is, well, if this continues down, might home prices be lower in the coming months? And time will tell. But for now, I think just given the lack of supply, no, it seems like a significant decline would be unlikely. Let's touch on some other variables here in the space. And one is consumer sentiment. The reality is, and I think a lot of this has to do with the tariff talk, if you look at the timing of this, but I think it's interesting to compare this to 2008 and 9 when we were going through a global financial crisis and unemployment rate was, 10, 11, 12%. Consumer sentiment is lower right now in the United States than it was back then. And yet we have 4% unemployment. The job market is still creating jobs at a fairly healthy clip. Granted, inflation is still running higher than longer term trends, but it's 2.5%. So it's interesting to me that we're seeing consumer sentiment be so low, given the fact that the reality, at least right now, is not all that bad.
Yeah, and if I could add to that, consumer sentiment took a U-turn and started to come up modestly in the latest reading, just like the price expectations of consumers versus actual inflation. Here's the funny thing about consumer sentiment. Most consumers are in really good shape. And despite our sentiment being somewhat sour, we continue to consume at a pretty rapid pace. This is an economy based on 70% of consumption. And so maybe we are assuaging our anxiety by consuming, but leisure and hospitality, airline bookings, cruise bookings, we continue to be a society that consumes. And so despite some crankiness, the ability of the consumer, and we may talk a little bit about this between the consumer that's locked their interest rate and those that haven't, is pretty darn good. And we have seen, I think, the bottoming of both consumer sentiment and price expectations in this cycle. The consumer is going to reorient themselves to I think, a little bit more happy mood here over the next 90 days.
I would expect the same thing. I think a lot of that was part of the uncertainty. But again, this is another graph that shows that, retail sales continue to climb. Households have a historically low debt to income ratio right now. So bottom line is the consumer, at least for now, is pretty strong. Another variable, the OBBB, you know what, not to, make a decision overall on the administration or whatever but this law was pretty friendly to the real estate industry. It gives us a permanent $750,000 mortgage acquisition indebtedness for interest rate deduction. Mortgage insurance remains deductible as long as it's part of the acquisition of a home. The SALT deduction, that is a huge one for Oregon, increasing from $10,000 to $40,000. Means that many of your homeowners who were paying more than $10,000 in Oregon income tax were effectively not deducting their property taxes, and so it makes the marginal benefit of owning a home even greater. Lifetime exemption. So for those home buyers who are receiving gifts from family, that increases and indexes that moving forward to inflation. So families who want to help young home buyers buy a home with a gift. They can now do that for the most part without any tax consequences. And then for those of you in the industry who operate under an LLC or S Corp, there are some benefits that they made permanent there. Now, of course, the unknown here is the impact that the OBBB will have on deficits. And Noah or I certainly are not tax professionals, but what we do know, and by the way, if you look at the reporting, many right-leaning think tanks are saying that the OBBB will be deficit neutral or even reduce deficits because of the economic growth. And of course, if you looked at left-leaning, they're going to say the opposite. I believe the CBO is coming out and saying that it is going to create larger deficits. Larger deficits fundamentally are not good for interest rates. And so time will tell for sure, but at least for now, we would expect the OBBB, one way or the other to impact interest rates. Tariffs, obviously an ongoing uncertainty. Hopefully in the next 60, 90 days, we at least have an idea of what we're doing moving forward. Of course, Japan's deal was announced yesterday and the market reacted positively. The stock market reacted positively to that. But in the next few weeks or months, we will see hopefully those deals come together and at least have certainty around what that's going to look like. And again, not going into pros and cons around that, but I think the bottom line is this is an ongoing uncertainty that is causing many businesses and households to pause and make any significant decisions. Now, we need to, this is not great news, Noah, but we need to be honest and transparent about the local jobs market. So although the national jobs market is still quite healthy, unfortunately here in Oregon and especially Washington County, the jobs market is unfortunately not as favorable as we'd all like to see. So you brought this data forward. I'll let you kind of explain it.
Yeah, Evan likes to give me the unhappy
It's a
slides.
good bag.
So, yes. Yeah, look, we have to recognize that we are in a different part of the economic cycle. Along with that comes jobs. There is a component of demand there that we should recognize, and Oregon is definitely moderating in terms of job growth and creation, as I mentioned earlier, and some of our largest employers are struggling. This list is actually not updated for the most recent enhanced announcement from Intel, which brought their total layoffs in Oregon, I think, to around 5,000 total jobs. I would point out one thing here, though, and that is to not, it might be tempting to conflate Intel or Nike's issues with the state of Oregon, and they are two different things. Intel and Nike have issues because of the way they have run their global brands, how they have executed their global strategies, how they have marketed their products, and where they have chosen to make their own capital investments. They are disconnected from separate issues that may exist in the state of Oregon. And so I point that out with those two employers specifically. And then, recognizing that from a business perspective, it has become an unfriendlier environment since 2019 to start a business, and we are feeling some of the pressure from that. And we have to look that in the face and understand that that's a part of some of the moderating demand issues.
Yeah. And I think it's also important to know in the state of Oregon, I believe it's something like we have, over 2 million people working and there's more people with jobs in Oregon than in the history of Oregon right now. So when we're talking about 5,000 jobs, it's a lot. And the fact that it's all happening at once will have an impact, at least temporarily, but it's not catastrophic. It's not going to bring the state down. We will move forward.
Very good point. More people working in absolute terms in the state and the metro area than at any point in time. Moderating growth. Mm-hmm. And so that has an impact on the forward demand cycle. Yeah, good point.
Okay, so listen, that concludes, I think, most of the topics. I just want to acknowledge there's a ton of topics that Noah and I considered bringing forth to your attention today. Obviously, time was not going to be able to allow us to do them all. The one thing that I want to address as a mortgage professional is Fannie Freddie. Obviously, there's a lot of understanding that Fannie and Freddie may come out of conservatorship and may become private corporations again. It's not going to happen this year. It may happen. It's going to take at least 2 or 3 years. They have to raise billions of dollars of capital to make that work. And the president has said that even if they do cut Fannie and Freddie from conservatorship, the government would maintain its either explicit or implicit guarantee. And that's what's important for us in terms of interest rates. So they're not going to cut that off. And so even if that does happen, I don't anticipate mortgage rates would be affected too much. But Noah, why don't you, I'll give you the benefit of sort of summarizing kind of the second half takeaways for these realtors who have stuck with us here. What can they do in the next 6 months to ensure a successful end of the year?
Yep, you got it. So here's kind of what the second half takeaways are. I think we think inventory is going to continue to build through the second half of the year in single family residential, and I think you will see fewer multifamily residential vacancies in the market. I think pricing will continue to moderate. That doesn't mean fall, but I do think it's going to continue to moderate. Sellers are going to need to send signals, and buyers are going to need to receive those signals. Rents will begin to stabilize. They already have, and they will begin to creep up in multifamily, I think, by the end of this year and first part of next year. I think Evan and I agree on this. I would not expect a 30-year mortgage rate on average below 6% for the remainder of the year. That has demand implications, and we are going and are seeing, this is not a forecast, employment is moderating in the metro area. That's a forward look at demand. We showed you the permits, though. Supply is going to, I think, contract faster after the summer selling season. I think sellers are going to retreat to their low payments and low interest rates if their home didn't sell. They have a point of price capitulation. They'll decide where that is based on their goals. But I think you're going to see a faster drawdown of inventory at the end of the year. And we showed you new construction is 2 years ahead of this cycle already and has begun to moderate downwards. So if you're looking for oversupply as an influencer on prices, I just don't think that's coming in the next 6 to 12 months. So this is, sort of cheeky advice because it's probably true in every market. But for a seller, my advice is your first offer is likely your best. If a buyer has made you an offer, it means they want to buy your home. Engage with them. See if there's a point that you can come together and make a deal. That first one is probably your best offer, and in fact might be your only offer. And remember, sellers, that you are buying and selling into the same market. Even oftentimes, if you are moving to a different market, most of them are in moderating cycles right now. You're buying and selling into the same market. Remember that. So whatever the buyer does to you, don't worry, you can turn around and do it to another buyer on your purchase. And then for buyers, I would say, I think Evan and I both feel strongly about this. Be active in the marketplace. Make offers. Be opportunistic. A good time to negotiate. Sellers, if you have 30 to 40% of sellers lowering their price, they are fishing. They are changing their bait and telling you, we want an offer. Bring us something that we can look at. Be out there. The part of this that I think we forget is get excited. Get excited at the possibility of home ownership. Look at what may be available to you today that wasn't a week ago. Make market offers that make sense for you. And you may very well find that this market meets your expectation. And I think that is exciting. I think there's good opportunity for some buyers in this marketplace. So I think that's a wrap up on takeaways.
Great. Well, we're just about to the end of our time. I think we've answered most of the questions in the Q&A. I know there is a question here from Cheryl asking about Nike layoffs, and I don't know the exact number. That'd be something you'd have to dive into. But if anyone has any questions, you can maybe pop them into the chat or the Q&A. Otherwise, we'll turn it over to Diana, and she can wrap this up for us.
Thank you so much. Are we going to have the slides? I've had questions about getting the slides. I can email those out to folks.
Do you want to email them? I can also probably drop them in the chat right now if people want to stay on for a second.
We could do both. You could drop them in the chat. I'm going to send a follow-up email to everybody that has a link to the recording so you can review it and then the slides as well. So we'll do that. But I want to thank Noah and Evan ever so much for sharing your insight and expertise. This has been amazing. Thanks to all of you for joining us. I hope the information shared today supports your conversations with your buyers and sellers. Helps you guide your clients with confidence, and it's backed by this real data and real market trends. Keep an eye on your inbox because your CE certificates will arrive within 3 business days. So at the latest Monday, you'll get those. And if you have any questions about the webinar or want to connect with our speakers, you can feel free to reach out to me or Noah and Evan. You probably have their contact info as well. anyway, we're happy to help you get connected. And to stay up to date, I put the PMAR education events link in so you can see more great upcoming classes and events that we've got. And again, thank you, Noah and Evan. We really, really appreciate you and what you bring to PMAR.
Thank you. And I wasn't able to drop in the chat because it's on my computer, but Diana, you'll send those slides out. So all good.
I
Thank you
sure
guys for
will.
coming today.
Yeah. All right,
All right.
everybody. Thank you. Have a
Have a
good
great
rest
one.
of your day.
Bye-bye.
Bye.
Thanks, Diana.
Thank you. Talk soon.